Zori here. It's Friday, the 30th of May, 2025, with your end of week update. Going to keep it fairly brief today. At least I'm going to try to. Going to start with the written blog from this week, where I said that this market is as headline driven as any market I can remember in my 41 years this August of doing what I do here at Private Wealth Advisors. Titled it Noise versus Signal, Drivers in the Short and Long Run. And Cameron Kreis is, I would say, one of my favorite macro analysts. He's very objective, very straightforward, and very data-driven, and does a ton of deeper research on, I think, important topics related to markets. And recently, his last podcast, he talked about the noise in the market, and he did his own analysis in terms of what tends to drive the market short-term and long-term. And he quotes the great Benjamin Graham: in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Put another way, while economic and earnings fundamentals represent an investable signal over long periods of time, in the short run, they get drowned out by a cacophony of noise. And of course, that's all the more so in today's market. Since 1954, 84% by his analysis of the change in the S&P 500 is actually explained by earnings, corporate earnings, with the remaining 16% being explained by the expansion in the price to earnings ratio, or the price to earnings multiple. And essentially what that means is, when you say it's a multiple driven market, it means that the price of stocks are going up at a rate that exceeds, you could say, the rate of earnings growth, meaning the price to earnings ratio is expanding, getting larger, meaning the price is getting higher relative to the per share earnings. When you have growth in the market and the price to earnings ratio is actually staying the same or at least shrinking, meaning earnings are actually rising at a pace faster than essentially the measured pace in the price of stocks, well, then it's an earnings driven, and I would say it's a fundamentally driven market at that point. So again, unsurprisingly, in the long run, it's the earnings, right? It's the fundamental growth in the companies themselves and their earnings that determine how stocks are going to do. And then when we look at it globally, it's the same. Pretty solid correlation positively between changes in the level of the index and the relative changes in index level earnings growth. In the short run, however, it's very, very different. Since 1954, using the same methodology, something like 98% of the monthly change in the market, or in the S&P index, is a reflection in the change of the PE ratio, which again we're calling the noise of the market voting machine. The signal of the market weighing machine of earnings really only explains 2% of the monthly price action. He ran the same analysis looking even on a 12-month basis, and 68% of the market moves were the result of the noise in the market. So noise can definitely dominate signal. So hence, we at PWA are long-term investors. Could you imagine trying to game the market based on the noise on a consistent, ongoing basis? And what I say here, what's our takeaway? We remain, of course, open to all possibilities, but as we've illustrated, sustainable bull markets simply don't emerge from valuation metrics sitting where they are currently. But, however, or of course, in a noise-driven market, that in no way means that we won't see fresh all-time highs in stock prices before the market ultimately succumbs to present fundamental reality, suggesting until stocks actually roll over and correct these excess valuations, if you will. But on the other hand, who knows? Maybe through productivity gains, great gains from artificial intelligence or what have you, who knows? Maybe fundamental reality can rise to meet the present level of stock prices. Of course, that remains to be seen. We will continue to explore the possibilities and reflect the probabilities in our asset allocation. So, speaking of that, today is no exception. The president woke up this morning and posted on his social media platform, "No more Mr. Nice Guy" on China. Scott Bessent in a TV interview was a little more staid, if you will, and he said, we're at a bit of a pause. I think the two leaders who get along really well need to get together and talk this out, and I'm sure we'll come to some, positive outcome. And, folks, I've said this, and I said it last week with regard to the 50% threat on Europe. There will be an outcome that is not 30% tariffs on China and 50% tariffs on the Eurozone. The reason being is because those scenarios are very recessionary, and that's just not a politically tenable outcome here at this juncture, or typically at any juncture. Politicians will move heaven and earth to the extent that they can to keep recessions from happening, even though recessions are, I think, important, economic phenomena. So to that point, here is from an interview or a podcast with Grant Williams and Demetrius Kafinis. They're doing a very interesting series of podcasts, and they featured Charles Calamiris, who is a very respected, decorated, if you will, important economist on the global scene. And by the way, Calamiris is, I think, on balance, very conservative. Can't really speak to his politics necessarily, but when you look at what he champions, free markets, small government, and so forth. And he said here, it feels as though there are economic constraints, but there are also political constraints. And that's kind of my point, right? The political constraints, the promises are we are going to go hard and correct these imbalances. I'm using air quotes because we've talked about what current account deficit means relative to a capital account surplus. There's an offset there that has been very favorable for U.S. markets. Hence, when we get these threats of big tariffs, you can see what the market does in response to that. Unfortunately, one will trigger the other if you cater to the economic constraints, meaning that the economic constraints say that you really can't do what you're threatening to do. But that's going to be politically unpalatable, because if your base is saying, hey, this is what we want you to do, well then politically you could be in trouble if you default to the economic constraints. Now, if you trigger the political side of things and you do the things that are expedient for your base, it will result in you maintaining a grip on power, but you're going to trigger the economic constraints, right? So the political constraints say that, show us that you are going to punish these trading partners. The economic constraints say that if you do, the markets are going to crash and we're going to have a recession. Now, I don't know that I completely agree with this narrative, and this is just the other day, because from what the recent polls are saying is that even the Republican community isn't on board necessarily with these big-time tariffs. In fact, as we go, they seem to be less on board with it. And I think that's the market, right? And I do think the market is influencing the actions from the administration. Now, of course, as the administration changes tact, as it realizes that probably can't go as big as was threatened, the president is catching a lot of heat. And they've even come up with an acronym that is very insulting to the president, and I think he's taking issue with that. And that was presented to him just within the last 48 hours. And ironically, we woke up this morning with this very strong kind of in-your-face, no more Mr. Nice Guy. So to what extent does that trigger the political constraint for the president and needing to, maybe not turn so quickly on these trade threats and look tougher, for one, just from a negotiating standpoint, right? If we continue to make a threat and then literally within hours contract or pull back on that threat, then suddenly the credibility of the negotiating tool is probably somewhat weakened. Problem is, if it's political constraints and the president gets back to kind of that tougher stance, well, then the markets may react. So right now, as I speak, the S&P is down about 0.25%. Volatility is on the rise. The Dow is flat. The NASDAQ 100 index is down about 0.25%. And by the way, as I typically do, I report to you on our core, and it's down 0.25%, 0.26%. It's more influenced today by a 0.75% decline in gold. We're not capturing quite that much. The hedge isn't having a big impact today, but it will if it continues to fall. Emerging markets, as you might imagine, are down 1% because of that, no more Mr. Nice Guy. And that was directed at China, by the way. So pretty much tracking the market today on a year-to-date basis, we are significantly outperforming the market. So I said I was going to kind of keep it quick. There was a bunch of economic data that I was ready to pull up and sentiment data. Let me just tell you that the soft data doesn't look good. The soft data in the aggregate suggests that the jobs numbers are going to start waning here in the months to come. The consumer spending data came in pretty close to as expected. I think actually consumer spending was up a little bit. Some of that pull forward action to get ahead of tariffs is still in the data. Inflation data today was relatively tame. We'll see how that plays out going forward. So in a nutshell, I'm certain when I score our index later today or over the weekend, it'll probably be still in that -10 score. So still slight recession risk going forward. Again, I had a lot of that dialed up, but I think I'd be here all day if I pulled it up and shared it all with you. But we're going to get some of that here right now when we look at the charts. So in terms of the data, before I get to the technicals, let's get to some of these ratios that we track. I'll just start with staples versus discretionary. So this line, and this is year to date, goes up or down by the percentage outperformance or underperformance of the U.S. Consumer Staples Index, in this case the ETF that tracks it, and the U.S. Consumer Discretionary Index, or in this case the ETF that tracks it. And you can see that although it's come off the boil a little bit, staples, which are the things you buy to stay alive, are up 9.6% more than discretionary, the things that you spend money on because you got a lot of extra money. So this can be an indicator of what the market thinks is going on in the economy. And staples are outperforming just in 5 months to the tune of almost 10% more than discretionary. So that may say something about economic prospects going forward. Our notable outperformance this year is largely due to the fact that international stocks, developed markets, are outperforming U.S. stocks to the tune of 14.6% year to date. And that speaks to those valuation mismatches that I've been showing you for at least the last year. Emerging markets are up 8.6% more than U.S. stocks on a year-to-date basis. You notice they're falling today. They're falling at the moment, and that's over this, again, trade threats toward the largest emerging market that would be found in most of these indices. Gold has been a big deal for us this year, 24% better than the stock market. And so, as you can see, when you look at these ratios, a globally diversified portfolio that does touch on precious metals and commodities and so forth, like ours, is having a really good year on a relative basis so far. And bonds versus stocks, typically, as you see here, where stocks, or I should say stocks versus bonds, where the S&P was underperforming the long-term bond index, in this case the ETF that tracks it, by nearly 20%. Stocks have had a really nice comeback rally. Bonds have been worried a bit about inflation. Bonds are now negative on the year. So stocks are outperforming bonds by nearly 2%. And this is the S&P 500 versus the long-term Treasury index. And we'll see how that plays out. I think this is going to continue to be very, very volatile. But this, in a sense, flies in the face a little bit to the point I made back here with staples and discretionary, with staples doing so well. Bonds should be doing much better, and they were. But now you've got this push and pull between, recession, bonds should rally, no recession and inflation plus tariffs, bonds will fall. Bonds falling, by the way, means yields are rising, and I think that's a serious headwind for stocks, and I've talked a lot about that, and we can skip that one today, but no doubt we'll talk about that more in the future. Now, lastly and quickly, looking at the charts, the 1-year daily chart for the S&P 500, you can see we've come bounding back, had this big gap above the 200-day moving average, came down, tested it successfully, kind of meandering around up in here, a bit off of all-time highs still. When you look at the momentum indicators, of course, the price tells you that momentum is dying. Little overbought here. No divergence really at this point, except when we go to the longer-term charts, and this is what should concern us more, frankly. When we look at the weekly S&P 500, the 10-year weekly chart, you have almost, again, getting back to these all-time highs, you're not even going to come close on the momentum indicators. You're going to get very, very steep bearish divergences, which typically would suggest that this rally is not something to be buying into right here. Same thing on the monthly. I'll skip that one. And also same thing on the NASDAQ 100 longer-term charts. But here's the daily chart. This one's more concerning. This one is now a rising wedge pattern that we're just now today breaking below the uptrend with very real bearish divergences from an overbought position and from a very high level of momentum. So this suggests that odds favor that this rally is going to stall. Maybe we get another shot up. It would be on trade news, but I'll be surprised if we don't at least go down in the short term and fill this gap, which is considerably lower than where we are right now. Working on my dollar chart here, I had this trend line, but this one now probably makes more sense. So I'm going to just get rid of that particular trend line. And so the dollar has been bumping up against that and showing some resistance right there at that trend line. We'll see. We'll be talking more about the dollar, no doubt, as we go. In terms of yields, we had pretty big move in the 10-year yield. That's when bonds were taking a dip. Remember, the price of bonds goes opposite the yield. This kind of looks like a bull flag pattern to me. If it is, that's not going to be a good sign. But this would be, I think we'd need better economic data, or the hard data hanging in there, if you will. And then the threat of tariffs, could push yields higher. Just folks kind of, continuing to sell U.S. Treasuries because they're concerned about geopolitics or what have you, would push yields higher as well. So again, depending on who you talk to, there's always theories about what's really going on and so on. Probably should default to the economics. If the economy continues to weaken, yields will come down. If it strengthens, yields will probably go up. But I do recognize and appreciate the arguments that there could be some flow away from the dollar and into foreign assets. I do think that's going on in the equity space, which we anticipated, which largely explains what I showed you earlier as to why we're having such a good year so far, anyway. And then gold, I told you, gold's a pretty good position for us. I'm very concerned about it. In the short run, the technicals do not look good to me, so we're hedging it. Long term, we are as bullish as we can be on gold. And I've talked about why, and we'll talk about it, I'm sure, more going forward. Lastly, breadth. S&P's down about a 0.25 point, like I said, but breadth is really not good. So if staples, utility, and healthcare are the only three that are up today anyway, just today, and today does not a trend make, the market is favoring defensive stocks that tend to do better during recessions, and disfavoring your cyclical stocks. I mean, energy is down 0.75 point. Tech is down 2/3 point. Materials are down 0.5 point. Again, we won't go running off with this one. That's going to be a longer term trend, but I have shown you on a year-to-date basis there may be something to this. And then, that's it. So folks, in a nutshell, I think clients, you just need to understand why we are are as well balanced as we've ever been. Doesn't mean we can't have some notable down days, and we're hedging against, catastrophe right here. But because there are opportunities, particularly globally and in places like, precious metals this year so far, we've been very pleased with the outcome to this point this year for clients. Thank you as always for watching and listening. Hope you have a wonderful weekend. Talk to you soon. Bye-bye.